Hello Propenomix people, and welcome to the Sunday supplement from the 14th of January 2024. This one I've called Going Overground. So, as you'll know, I like to start with a quote, and this week's is, "The creation of 1,000 forests is in one acorn." That's from Ralph Waldo Emerson, the American essayist. So, before we begin, there's a couple of new pieces of content on the YouTube channel that I just wanted to let everybody know about. I have committed to one piece of content as a minimum every day in 2024, which is obviously a big deal. I'll be releasing a macro blast for those who want to keep abreast of some of the pieces of news that make the economy tick that I look at every single day. But I've also got a new video series on the go, which every Wednesday I'm releasing a video in my series, The 4 Pillars of Investment. I'm actually releasing 2 videos, one 60-second short and one longer form explainer in a similar format as I did my advent calendar. If you missed the advent calendar, it's well worth going back and checking out the playlist on the YouTube channel as well. And if I could ask anybody who's listening who hasn't already, please could you like this video, subscribe to the channel, it helps me out an awful lot, and please leave me a comment because it makes a big difference to the YouTube algorithm. Thank you very much. So, after we get to the end of this one, we'll be 2 supplements down for 2024 and 50 to go, even though it's a leap year. When you're really lucky, there are 53 supplements in a year. I'll leave that one for you to think about. Fairly soon, the New Year feeling will be forgotten. The internet is full of lies, damn lies, and statistics about how long resolutions last, as I'm sure you know, but let's make the most of it while we have it. Whilst the boundary to each year is effectively arbitrary, utilising anything that gives you and the people around you a bit of extra pep in the step has to be a smart move. Keeping the fire burning is always the challenge. I always feel January is the craziest month to ever try and be extra disciplined. It's dark, miserable, long and cold, and often wet or snowy. No wonder those resolutions don't last. But there we go. Shall we try some resolutions at Easter? I'm not sure that'll take off. The macro isn't incredibly detailed this week, although there's been moves of interest, but I'm using that rare bit of breathing space to share some extra interesting snippets that I've been reading from the Bank of England. The transparency has to be credited, although there is a risk of setting conspiracy theory hairs running. You won't hear about those in the supplement, but there's always an upside and a downside risk to anything that's made public from important large public institutions. So let's tuck into that macro. 16 metrics of interest or macro events that are widely publicised that occurred this week. And once again, I'm going to narrow down the scope somewhat to the deemed important ones as the market dictates, and also the ones that I think are both interesting and important in building that ongoing picture of understanding the UK economy as it relates to property investors and developers. I'm kicking off this week with one that, again, doesn't get a lot of column inches, or whatever you call the equivalent in audible terms. Words, I suppose, or seconds. Anyway, that's the BBA mortgage rate, the reversion rate, lender's standard variable rate, SVR, or whatever you prefer to call it, reported by the Bank of England monthly. We had a peak at 8.05% in October 23, and it had been flat really in November, but we are down underneath that massive 8% milestone to 7.96, which was a shade under consensus, mostly because the bond yields had dropped faster than expected in December. Perspective is always good. A couple of years ago, this was in the 3.6% region, although the post-financial crisis number would be more accurately measured at an average of roughly 4.5 before we get too excited. What will it take to move this number back down? Quite a bit, but the direction is definitely downwards, simply because the short end of the yield curve is sloping downwards. As the 3-month gilt yield comes down, this number will trend downwards. A best guess for the end of 2024 sees it as around 7%, which is still eye-watering for those holding stock on variable rates. It'll be a cold day in hell before the bond yields and swap rates don't get a mention in the macro metrics section of the supplement. The 5-year gilt traded in a tight range, opening at 3.68% on Monday morning and closing at 3.55% yield on Friday afternoon. The more interesting analysis is what this means in the face of a week where the news, by right, should have meant higher yields, arguably. Why? Because when the economy is appearing to do a little better than expected, interest rates would be expected to stay higher for longer. What took over instead? Fighter jets, oil prices, and the Houthi rebels did. Conflict drives bond yields down because money flocks to the safety of the bond market, even though it also drives inflation upwards, especially when that conflict is in the Middle East or directly involves securing the passage of goods and cargo ships, including oil, of course, through the Red Sea. The Suez Canal is so viable because it's an awfully long way around otherwise, and container prices are up from $1,000 for a 40-foot container from Shanghai to $4,400 relatively quickly, although they were up to $15,000 at the COVID peak. The relatively uninformed opinion, remember, is that when a geopolitical event of aggression breaks out, that the economy of countries involved will suffer. That's usually incorrect. If the UK, for example, had to spend more money on defence at any point in the near future and needed to borrow to do it, the GDP of the UK would actually increase. My takeaway from this week is that the events in the Red Sea have been deemed to be more important than what has happened with the GDP figures for the UK that were also released this week. And those figures for GDP were a 0.3% increase in GDP for November versus a consensus of 0.2% growth. Just ahead of the game. You wouldn't expect a major shift on the back of that anyway. The 3-month rolling number, however, moved to minus 0.2%, mostly still reeling from a minus 0.3 event in October, leaving the possibility of a technical recession, remember, 2 quarters consecutively of negative growth, as a reasonably high one. NISA, the National Institute of Economic and Social Research, who produce flash estimates, have December growth leading to a quarterly GDP figure of 0.0%, which would avoid that technical recession by a hair's breadth. As I've been saying for around a year now, whilst the R word is important, the difference here is absolutely at the margin. Either we will have shrunk by 0.2% in 6 months in real terms, or else we will have shrunk by 0.1% in 6 months in real terms, unless we get a real upside surprise for December. December's inflation number is the first step, of course. If the Christmas sales were aggressive, then this would have an impact, as would the service industry having a slower month in December typically. We will see. It's pretty much all psychological here though. The consensus, which I agree with, is that we will see a return to growth in Q1 2024, and that will either stop a recession or calm us down a little. However, this constant commentary that inflation will now, in the UK, come under control as a country that tends to run hotter than the Eurozone and the US, when neither of those are truly under control. Indeed, the US printed a surprise move upwards in inflation for December, up to 3.4% on the overly reported CPI, but with core still at 3.9%. No real substantive move downwards for 7 inflation prints in a row now in the US. So that seems laughable to me. We have taken the low-hanging fruit of cheaper petrol and food inflation reversing. Once those are over, if services inflation is still running hot, we're just heading for more of the same, stuck around the 3.5% to 4% mark. Now look, I'm largely out on my own in this view, but I'm happy there. Many commentators I respect are saying inflation will be 2% by April, and I'll be the first who is happy to be wrong, but I'm not having it. I've marked the card here, and I'll be accountable for it. That only leaves the final metric worth a mention, construction output. Year on year it has increased 0.9%, so it's been hammered by inflation realistically. Nowhere near as bad as some of the bearish forecasts, but obviously a real terms contraction. November's figures were also weaker than hoped because of some storms and extreme weather events that really don't seem so extreme anymore. On the subject of weather, I listened to one interview of particular interest this week with the economist Steve Keen. The point that really made my ears prick up was around climate change. Keen was keen to point out that economists are very poor in general when discussing climate change, because they tend to only look at temperature changes, which can be argued to be a net positive, and not precipitation increases, which are universally accepted to have a negative impact on global food production, according to Keen. I haven't heard the argument formalised in this way before, and I just thought I'd mention it here as an aside of interest around the rainfall across the UK. The Met Office looked to be on the same track as Keen has outlined because they focus on the fact that 2023 was the second warmest year on average ever for the UK, which has to be considered significant of course, and the record year was 2022. So that speaks to a seriously significant trend. And then well below the fold, they discussed the rainfall side of things. The rainfall was, in fact, 11% above average, although a lot of the storms would be lost in the averages, of course. There was 48% more rainfall than average in December across the UK, where the storms show a little more clearly. I want and need to look at this in more detail in the coming weeks and months. I do have particularly long-term concerns over expanding flood risk areas, but these numbers do seem to have significant outliers in them. However, what averages conceal, alongside many other things, is the concept that at the extremes, such as a storm, things get much worse quite quickly. Now that's only a hypothesis at the moment, while the averages don't move too much at all. This isn't mentioned in the Met Office review of the year, unfortunately. Okay, that ties up all the macro and leaves me to steam into my soapbox topic of the week, the Bank of England Overground. Nope, that isn't what the bank's workers do when there's a tube strike. The bank publishes some of their research work, which is informing internal conversations at the bank on a regular basis. Well, actually it's an irregular basis. I mean, I'm grateful they're doing it, but here are the 2023 release dates in order. 20th of Jan, 20th of Jan, 22nd of Feb, 27th of Feb, 4th of August, someone took a few months off, 8th of August, 22nd of August, 25th of August, 12th of September, and then another gap till the 15th of December 23. So you'd be forgiven for thinking that the employee in charge of the blog either changed in March 2023 or left the bank. August is a great month to catch up while everyone's on holiday, or to slip out some interesting news and largely remain unnoticed. Sorry to be so cynical. And then the new wave died off before one was published on the last relevant working day of the year for the bank. Anyway, I do remain grateful for the insight. I referenced the 12th of September piece in my New Year's Eve supplement, since it was the precursor to their larger report on buy-to-let and financial stability, which was published in December. Here's the exec summary in the bank's own words regarding the December blog entry. Our latest survey of British household finances shows that mortgagors are adjusting their behaviour to both actual and anticipated increases in mortgage payments. The latter suggests that the aggregate reduction in spending may materialise faster than the rise in mortgage costs. This is very textbook economic speak for those who don't know. The theory of rational expectations. Logically, if you had a mortgage, you'd have to be hiding under a rock not to know that interest rates have been going up. People are therefore being proactively reactive, is the way that the bank is laying it out. Let's take a closer look. The research question here is, how are households adjusting to rising mortgage costs? The thinking is that increased costs may reduce household spending on other goods. For it not to, households either need more income, to borrow to maintain levels of spending, or a bit of both. This is the bank making further inquiries using surveys. We'd rather see a study based on actual measurements and actions, rather than what might well be intentions that are not followed through. And this is what we've got. So the most recent survey was carried out between the 30th of August and the 19th of September 2023. I'm afraid this stuff is just never up to date. This is as good as it gets, frustratingly. 40% of mortgagors reported an increase in their rates in the past 12 months, which seems much higher than suggested in other surveys, but that must include, of course, everyone on a variable rate, half of the people on 2-year deals, roughly, because you'd expect half of them to drop off in year 1 and half in year 2, and then 20% of the people on 5-year deals, because again you'd expect around 20% of people each year to be dropping off. Other terms are available, of course. That's just a rough average from me. So the big finding here is that for every £100 increase in mortgage payments, on average the household surveyed cut spending by £50. As above, they either had to bridge the gap by earning more or saving less, borrowing or dissaving. That's for those, the 40% who've already faced the increase. For those who are now expecting the increase, they cut their spending by £28 for every expected £100 rise. And they're looking to increase that to £37 in the year when the rise is actually coming. This week's graph shows what people have actually done in the face of the higher payments, and then what they intend to do in the expectation of them. I would much rather concentrate on what they actually did rather than what they say they're going to do. Context is always important. At the point of the data collection, the 5-year gilt yields were around 4.3% on average. This compares to today's 3.55%. So, by proxy, the 5-year interest rate should be around 0.75% lower than it was when this survey was taken. Also, the 2-year is down from circa 4.8% average when the survey was taken to 4.16% today. So that's about 0.65% cheaper-ish. At the very least, this means less sacrifice, of course. About 53% of people took no action at all on the basis that payments had gone up. Well, presumably the action they took is that they just paid them. What this means is that they didn't change their behaviour. 31% of those surveyed spent less, 13% worked longer hours, 4% got an additional job, 2% requested a change to their mortgage, presumably longer terms or interest-only periods perhaps, and then 4% did something else. On those numbers, about 7% of people took more than one action. Unsurprisingly, the closer the mortgage drop-off date was, the more, as a percentage, of people took action. However, perhaps surprisingly, even those who had a rate lasting till 2027 took action 38% of the time. That's significant, and perhaps speaks to just how worried people were. We have to wait until September-ish 2024 for this survey to be repeated, and then wait a bit longer for the results to be released after analysis at the bank. The current market would suggest we could do with something more regular, more cross-sectional, and more real-time, but nothing seems to be forthcoming. I look forward to anticipating the bank's next big beefs, or bees in their respective bonnets, by keeping an eye on the bank Overground information, but of course I can't say with regularity when something of interest will next be published. So I'm going to leave you for this week with a final thought, and that is Rightmove's 3 predictions for 2024. Number 1, landlords will have to balance priorities to get the price right. That's referring to rental affordability. Number 2, landlords may delay green improvements in the face of the Renters Reform Bill. I'm not convinced personally those two things are related. I think it's just the reaction to Sunak scrapping the EPCC targets for the minute. Although most people who are thinking long term know that I'm sure something is coming in on that front in the future, either with a change of government or simply a change of leader. And then number 3, the rental market will remain under pressure thanks to stretched affordability to buy. So by the prices and the mortgage rates keeping more people out of the ownership market, that's what Rightmove think we should be concentrating on. Now, none of that is particularly bullish, nor are they, in my opinion, the 3 biggest issues in the sector, although the Renters Reform Bill in general is big news, there's no two ways about it. Still, the most respected voice in the industry on the sales side, that near monopoly, rightly or wrongly, people will listen. So, as always, well done for getting to the end. Don't forget that new 4 Pillars video series if you haven't checked it out yet on the YouTube. I'd love you to subscribe, like this video and leave me a comment if you wouldn't mind. I really do appreciate those who support me spreading the word, and more subscribers will lead to more and better content on the channel. You know that only one remaining sentence. You know what it is. Keep calm and carry on.